Welcome everyone. It's David Paul speaking. Welcome to our webcast, The 10-Minute Investor, where I'm going to do my best to show you how to consistently outperform the stock market in a few minutes a day. Okay, so it's great to see you all, and I'll do my best to try and be as focused as I can and make the webcast last about 40-45 minutes. So here's my big promise to you today, ladies and gentlemen. If you stick with me to the end, you'll be able to invest with confidence and consistently outperform the stock market in a few minutes a day. That's my promise to you. Now, that's me. I'm 63. I've got a PhD in mathematics, MSc in metallurgy, and BSc in mechanical engineering. I put on my first trade in October 1982, and I'm glad to say it was a winning trade. And I traded while working for De Beers from 82 to 88. And April 1988, I cut the corporate umbilical cord, and I've been trading on my own ever since. Along the way, I started to do some seminars in the stock market purely by accident. I went to an investment meeting one night, and the chap who was taking the meeting had laryngitis, so they asked me to just stand up for a few minutes and talk about what I was doing. And that led to an invite from a major bank to come along and coach their traders into how to becoming more consistent. And I coached pretty much all of the major banks around the world on how to become consistent in their stock trading and in their futures trading. And for the last few years, I've been helping retail traders to improve their performance with VectorVest, and I'm the managing director of VectorVest in the United Kingdom. So that's my background. So you might be saying to yourself, what am I doing here? Well, you're in the right place, folks. If you're tired of buying stocks and seeing them drop right after you've bought them, it's as if there was somebody watching you. Well, certainly there's going to be the odd shade that goes against you, but what we can do is we can put the probabilities firmly in your favor. You're in the right place if you don't know when to get out. Well, I think that when you've been in markets for a while, you can get your entries correct, but knowing when to get out is much more difficult. And it's so easy to have a winning position and allow that winning position to turn into a losing position. And if you want to sort of flush away your trading confidence, do that too often. So knowing when to get out when you're correct and how to manage the trade, and knowing when to get out when you're incorrect is a very big part of this game. So you're in the right place if that's a problem. You're also in the right place if you don't feel that you've got enough time to manage your stocks. And my promise to you is to show you how to be able to manage your stocks in a few minutes a day. And this is the most common when I do this talk around the country, that the market has in fact knocked the stuffing out of you over the years, and you've lost all confidence in yourself that you can actually make money in the marketplace. And of course, you're in the right place if you just want a simple way to buy the right stocks at the right time. Okay, so that's what we're going to try and achieve, folks. So today, I'm going to learn part number one is how to move from being inconsistent to consistent. And that's what I spent many years teaching the banks. Part number two is how to pick the best stocks, folks. And part number three is a 10-minute portfolio management plan to put that all together. So let's get cracking. At the end, I'll give you a template which will allow you to tick the boxes and to put this all into place. It's the same template that I use for my own trading. So, a question. There's a little chat box, and if you could answer this honestly, I would appreciate it. What's the hardest part about making money in the market for you? This little talk's about you, not about me. Okay, first question saying getting the time to do anything. Yeah, it's a busy little life we have these days. Exits is coming up again. As I said earlier, after a little while you can get your entries correct relatively easily, but getting your exits is much more difficult. Shares moving against me, holding on to losers. Okay, that's again exit. So exits tend to be coming up mostly. But folks, I think you can cut yourself a little bit of slack because most investors fail, and this was brought across by this survey by the Dalbar Group some years ago, where they looked at a 20-year period up until 2015 of the American market. And the S&P 500, which is the top 500 stocks by market cap, over that period increased by 8.19%, and the average stock investor got half of that. And that's also institutional investors, I assure you. And inflation was 2.2%. So the average stock fund investor, in fact, underperformed the index by 50%. So it's so easy to be like this fellow and curse the market. I'm sure we've all been there. It's really easy for very quantitative people to label themselves as a failure. But folks, if you know what you're doing, you don't have to stress about your trades. You've got things under control, and you can trade with confidence, and that's where we want to try and get to. So let's move apace and tackle section 1, which is very close to my heart. It's all about moving from being inconsistent to consistent, and I think you would agree there's no point in making £1 million and giving the darn thing back again. So we want to get to a point where we can count on our money from the stock market in exactly the same way as we can count on our salary and we can count on our drawings from our business if you're self-employed. So I've noted this over the last quarter of a century, folks. 4 mistakes that come up over and over and over again. And just knowing about these mistakes will help you get around them. So mistake number 1. Mistake number 1 is thinking of the money first. Now, you may say to yourself, well, I'm in this business to make some money, and that's certainly true, and that's true of any business. But folks, if you think of your dentist, for example, your dentist will be driving a big car and his wife driving a Porsche Cayenne, largely because he focuses on perfect execution of each and every dental process. If he focuses on perfect execution of each process, of each root canal, then his waiting room will be full and he can pretty much charge what he wants. And it's exactly the same in the trading business. Your job is to focus on perfect execution of each and every trade, each and every investment, according to your set of rules. And if you do that, the cash will take care of itself. And when you don't do that, this is what happens. Emotional trades. So, think of the decisions that this young fella is making now compared to the decisions he would make if he was sitting calmly in his armchair at home. So, here's a little quiz. Have you ever said the following, ladies and gentlemen? I know it's down now, but it'll come back. It's already down 20%. I might as well hold on to it now. Have you ever said that? I've got a profit, but if I close it now, it'll probably keep going up. I know I lost more than I thought, but if I close it now, it'll probably go up tomorrow. The last time I sold a stock, it kept going up, so I'm not selling this one yet. So if you've ever said any of those, what's this? Frustration, fear, greed, despair, hope, a gamut of emotions, folks. And we've all said those things over and over and over again. And the only way to sidestep these emotions, especially the emotion of fear, is to ground your mind firmly in the present moment and focus on execution of the process in exactly the same way as a scratch golfer focuses on perfect execution of each and every stroke. When I used to do this sort of work for the banks, I would spend pretty much a full morning on what I've just talked about. It's that important. The next mistake, folks, is buying stocks that are falling. Now, this has caused more people to go bankrupt than anything else. We have user groups all over the country at VectorVest UK, and we have one prominent member of our Oxford user group who tells the story of Marconi. Marconi was a bellwether stock on the FTSE 100 for generations, and it fell from £13 to 6p. Okay, buying stocks that are falling has bankrupted more traders than anything else. It's the old 2 for the price of 1, and of course the fellows on the television every afternoon tell us to do just exactly that. It may work in exchange-traded funds, it may work on unit trusts, but it certainly doesn't work on stocks. So I did this webcast for VectorVest America a little while back, and we were in the webcast. I was asked about this stock called Windstream, and I was asked about the stock by a chap who just bought the darn thing, and he bought it for a technical reason. He said that that was a double bottom, and that there was a trend line break here. If I can do that, that's a very popular technical entry. Market breaks a trend line, goes back and kisses the trend line. So we felt that that break and kiss and the double bottom was a really good reason to get on board. Now, I looked at the share and I said to myself, this darn thing is making a series of falling tops here. And there's some other reason as well, which I'll come on to maybe in 10 or 15 minutes. But my recommendation to him was to actually get out of the position ASAP. And that was what I told him to do. And he, in fact, got out of it. And that's what happened a few days later. And then the darn thing fell out of bed completely. So buying shares that are falling is not a good idea. And there is a wonderful book out there called Reminiscences of a Stock Operator, written by Edwin Lefebvre 100 years ago. And the hero was a guy called Larry Livingstone, which was a pen name for a great speculator called Jesse Livermore. And in the book he says, I've never seen a share too low not to go lower and too high not to go higher. So just be very careful of that old 2 for the price of 1. It's a beguiling thing, and we've been sort of brainwashed that that's the way to go. A subset of that, of course, is holding on to losers too long. Let me tell you a story. In 1982, I started to invest, and I made a lot of money for that time of my life between 82 and 84. In 1984, I was sure this share was going to go up, and I got into it. It was far too big a position, but I got into it. And of course it didn't. It went the other way, and I held on to it, and I held on to it, and I held on to it, and I pretty much gave back all I'd made from 1982 to 1984. A very bitter lesson, and I spent a full weekend working on myself, making sure that would never happen again. Holding on to losers too long can wreck a year, folks. No exit plan. It's a bit like jumping out of a plane without a parachute. So every trade stroke investment that you put on, it's absolutely critical that prior to getting in, you've already decided how much you're going to buy, and you've already decided where you're going to get out. And that's Windstream. Okay, just fell down the page. And that would have been a very costly lesson. There's another share, came out of another American seminar, in fact, where a lady bought it up here, and they still hold it. And I asked her, why didn't she get out? There was plenty, apart from that gap, there was no shortage of liquidity to get out. And she said she didn't get out because her husband said that it'll come back. And so what have they done? First of all, they've missed the opportunity cost for a year. They've lost a heap of money, and they put a bit of stress on the old home front. And those of you that have been around the block will know that the home front is one of the more difficult ones to fight, and you don't need any pressure on it. At least I don't. So holding on to your losers, the third major problem area. And the fourth one is forgetting about market direction. And by market, I mean the overall sentiment of the entire stock market. And it's very much like this roller coaster, folks. The stock market takes a very long time to get up there, but it falls exceptionally quickly. And that's the American market. There's 2000, this massive bull market into 2000, the bear market into 2003, this bull market, and then, of course, this thing which is now labeled the global financial crisis, and the bull market, which we believe at VectorVest is still running. If you'd stayed in here, folks, the S&P was down 38%. Now, if you're down 38%, you've got to do 60% flashy footwork to get that back. So, folks, there's a really great time to be in the stock market, and there's an awful time to be in the stock market. And you need to know which is which. Now, you can use moving averages for that, that's for sure. Moving averages work reasonably well, and I used them for a long time, worked reasonably well for getting in, because markets tend to move up very slowly, and the lag, which is intrinsic in a moving average, is not too much of a penalty. However, they tend to fall very fast, and moving averages are a bit slow to actually get out. At VectorVest, we have our own proprietary market timing systems for long-term traders, investors, and systems for swing traders, which are much faster than moving average. But nevertheless, whatever you do, you need some form, in our opinion, of objective methodology to tell you when it's safe to be in the stock market and when it's not. So, and this is a gentleman who fell foul of that sell-off in 2007 and 2008. One of our clients, Robert, he writes, he had professional advisors for shares and trusts, and they built up a retirement portfolio over the years, and everybody told him to ride it out. And by halfway through 2008, he was down 40%, and he thought he was going to have to get a job. Now, we've turned that around for Rob, and towards the end of the presentation, I'll show you exactly how. So, which one of those has cost you most money? Now, I've done this talk quite a few times, and number 3 tends to come up the most. Yeah, number 3, number 2, a few number 4s. So holding on to losers too long, and a good portfolio, folks, you're going to get, let's say 10 shares, you're going to get 2 that shoot the lights out. You're going to get 6 or 7 that are up a bit, hanging in there, and you're going to get 1 that's a dog, and holding on to it can wreck your year. So really, really important to manage the trade before you get into the trade. Know how many shares to buy, and secondly, know where you're going to get out if the darn thing moves against you, and then thirdly, how to manage that trade as the stock goes your way. So, how can we fix this? Well, we've got a very simple fix, folks, and I like to picture it as this triangle. The first block in the triangle is stock analysis. We really want to get to know the shares that we hold, and we really want to get to know those shares that we're thinking of buying. I want to know their value. I want to know, are they making money? I want to know, are those earnings increasing? What's the safety of the earnings been over the last few years? Are they growing earnings nice and smoothly and linearly? Are all those financial ratios getting better, or are they up and down? Really want to get to know every share that we've got. Second thing that I want to know is to focus on exits. I want to know position sizing. I want to know my exit. If I'm correct, I want to know my exit. If I'm incorrect. Third thing is that I want to know, is it safe to be in the stock market? So I want some form of objective buying signal from the entire market to tell me it's safe to be in the market. It is my belief that at least 70% of the movement is a function of the sentiment of the general market, and 30% to do with the share itself. So I want to know objectively, not scratching my head or counting waves. I want an objective signal to tell me that it's safe to be in the market. And fourthly, I want a methodology to simply and easily and quickly cherry pick the very, very best stocks for my portfolio. The best defense is offense, as Sir Alec Ferguson used to say. And I want a simple little plan to tie the whole thing together that I can keep under control in a few minutes a day. Now, which of those, ladies and gentlemen, do you need to work on first? Well, I lead the way. I'll tell you that when I started to do this and put this together about 7 or 8 years ago now, I had personally to work on stock analysis because as a mechanical engineer, I just didn't have the tools to think about fundamental analysis, the study of value, the study of earnings, and all the financial ratios. I just didn't have the time to do that. So I ignored it completely. I was pretty good at everything else and a good technical analyst, but I ignored stock analysis. And when I put that into the picture, my performance increased enormously. So what else am I, which one of those do you have to work on first? I'm getting market timing and a buying signal a lot. I'm getting the plan. Ladies and gentlemen, in coaching traders at institutional and retail level, I have never yet seen a trader that didn't have some form of resistance to putting a plan together. Okay. Exits I'm getting. So a mix. For me, I had everything pretty much under control apart from the stock analysis part. So that's that. So let's look at how the top investors pick stocks. And the problem is that it's so darned easy to get buried in a mountain of data. And there's just some of the metrics. That's a report that one of our opposition chucks out pretty much every day. So where do you start on that? So that was me. I was trying to shift that little nut with the wrong spanner. I just didn't have the tools for stock analysis. I was an engineer. I have no formal financial training apart from what I did for the FCA a few years back. And I remember vividly the annual reports and the interim reports piling up in the corner of my office. I just didn't have the time or the inclination to actually get stuck in. Jim Cramer says that you need to put in an hour a week per stock. So if you've got 15 stocks, you've just created yourself a 60-hour a month part-time job. So it's absolutely critical as private investors that we can actually get that information quickly and easily and efficiently, because we'll never have the time to put the 60 hours a month in. Well, it's so easy to get totally and utterly confused, where one piece of data is saying buy, the other piece of data is saying sell, and I've been there many times myself. Convinced that you see something, and but absolutely critical, folks, as private investors, that we can actually get to the good stuff quickly without that 60-hour part-time job that Jim Cramer talks about. So here's the fix, folks. The founder of VectorVest, Dr. Bart Toledo, says that good portfolio management starts with buying the right stocks. And he makes this analogy between a successful portfolio and a successful football team. By filling the team full of the best players and managing them well, that in fact will make the team do well. So the very first step is to buy the very best stocks. And here's what he recommends, and this is what I'm doing. The stock price is steadily rising and it's not too volatile. The company's making money and growing their earnings, and I want to favor undervalued stocks. So, a little quiz for you, ladies and gentlemen. Those three charts are all yearly charts, yearly candle charts of three stocks that I've picked. 1, 2, and 3. Now, if you could only buy one of those, which one would you buy? Well, that's great. I'm getting 3, 3, 3, 3, 3. Yes, number 3 certainly, folks. Number 3 is already doing what you wanted to do. It's moving up the page. Remember that quote out of Reminiscence? There's no a share is too low not to go lower and too high not to go higher. I traded on the floor of the Chicago Mercantile Exchange for a little while. A vicious environment, I may add. And there the chaps used to say, the top and bottom pickers become cotton pickers. So if you've thought that that's a bottom, folks, well, you've just been darned lucky. Okay, so this share is moving up the page, and all you had to do really was to buy these breakouts. I'm not saying for a second that you don't buy a pullback in an uptrend, not saying that for a second, but nevertheless, if you've got a market that's making rising bottoms like this, relatively easy to make some money. And of course, you could consider this if you're a short seller on the short side. This one, in hindsight, it might have been obvious to buy there and to sell there, but try it on the hard right edge and see how you get on. An awful lot more difficult than it would seem after the fact. So if you don't believe me, just have a go. Okay. Whereas this is relatively straightforward. So I want to buy a share that's trending upwards with not too much volatility. The second thing is earnings. And at VectorVest, we don't have to hunt around the internet looking for earnings. We built that into the VectorVest program. And down below the share price, which is the previous chart, I plotted earnings per share. And as you can see on this share, earnings per share is growing from the bottom left to the top right of its window. And along the way, it's actually grown by 50% over the last year. It's grown nice and smoothly, folks. Now, there's a fellow out there called Ben Graham, and he's written he was Warren Buffett's mentor. And he's written several books on investments. And he says the following: earnings per share growth is the engine that drives the share price. Just think about it. If the company is making money, it can, first of all, attract the best people. Secondly, it can put more money into research and development. And thirdly, of course, it can buy out smaller companies. It buys out, let's say it's trading on a price to earnings ratio of 15. It can buy a unlisted company for 5, and immediately the unlisted company's earnings are re-rated at 15. So earnings per share has a strong correlation with the share price, and we have to take Ben Graham seriously. Earnings per share growth is the engine that drives the stock market. In property, they say that there's 3 things: location, location, location. Well, in the stock market, there's also 3 things. It's called earnings, earnings safety, and earnings growth. So anecdotally, from observation over the last 7 or 8 years, the smoother the earnings per share growth, the easier goes the trading. And this is a particularly good example. And the next thing is that I want to favor undervalued shares. And again, at VectorVest, we have an algorithm that calculates the value of every share on the London stock market and on AIM every single day. So we can see at a glance whether the share is trading below its value or above its value, and we favor shares that are trading below their valuation. And simply minded, there's much less risk there, and many people have told me over the years that the only way to make money in anything is to find the value of something and then pay less for it. So that's what we're looking for. Share price steadily rising, not too volatile. The company's making money and growing their earnings, and I want to favor undervalued stocks. Let's go back to that example of Wynn. Now, if you remember, I think the guy was called Steve. Yeah, Steve. He bought this share based on this double bottom and this trend line break. You know, I looked at it, and first of all, the share is trending down the page. Okay, it's trending down the page, but when I in fact put on valuation and earnings per share and a little bit of stock analysis, the probability of this being a breakout was relatively low because the share was trading quite a way above the VectorVest valuation. And secondly, earnings per share was falling off the side of a cliff. So the probability of that being a turnaround was in fact very low. So ladies and gentlemen, when you put the fundamental picture, stock analysis together with the technical picture, the trend, we can make much, much more intelligent decisions, and the probability of the share going your way when you get into it is at your back, much, much higher. So if you've got a problem with shares going against you quickly, this dual approach will help. Okay. And of course, there's lots of them. These are shares that I've been involved in the American market. I'll show some UK shares in a moment. At VectorVest, our standard package is VectorVest UK and VectorVest USA, and they are two different programs, but they come with the VectorVest subscription. As I say, we're not saying for a second that you don't buy a pullback in an up market, but you really didn't have to do much more than buy some breakouts here to get into this trend. As you can see, earnings per share rising and rising very strongly indeed, and we have a search on VectorVest that alerts you when you get this ramp up in earnings per share, because that invariably means the share price is going to move very strongly. Those of you that are technicians could easily have got in earlier with this textbook little flag formation. That's just a little bit for those guys that are listening that are technicians. You don't have to forget about your technical analysis, but apply that to shares with outstanding fundamentals, okay, and your hit rate's going to go through the roof. So there's another share, Skyworks, moved beautifully. Southwest Air has been a cracker, LUV. Look at that earnings per share move. This electronic semiconductor company had done NVIDIA, had a great run. This is John Lang. And John Lang, earnings per share rose here. And as you can see, as earnings per share ramped up, this is UK share, as earnings per share ramped up, we revalued the stock. So from about October 2018, the share was now significantly undervalued and growing earnings strongly, and it now starts to move up the page. Okay, and this green is our buy recommendation. So, and all you had to do, of course, was buy a breakout of these highs, or if you're a technical analyst, try and find some form of pullback. But nevertheless, moving up the page very strongly indeed over the last week. It's gone from £3 to £3.88 in the last 2 months. This is Elant Oil and Gas. The earnings per share growth here, outstanding, from 10 pence to 40 pence. As it ramped up here in terms of earnings, VectorVest revalued the stock, and it's now moving up the page very strongly indeed at this support level. And it looks to me as if it can go quite a long way yet. I am a shareholder in the share. I have to make it very clear, however, that although the share is suitable for me, it may not be suitable for you. But nevertheless, those are two shares that are undervalued, that are growing earnings strongly, and I'm a shareholder in both of them. Okay, very simple analysis. But let's have a look at the program itself. So if I get out of my PowerPoint presentation, end my show, and get rid of all my little drawings, and go into VectorVest itself. Now, what I've done, folks, is that I put together a very simple search. And this search is in our retirement folder, which means it's very conservative. We have got lots and lots of prudent searches. We've got lots and lots of aggressive searches, but this is for very conservative investors stroke traders, and it's called long-term winners. And here's what it does. It finds shares that are above 50p, that have got reasonable volume. The last thing you want is to be stuck in a share and you can't get out of it, but it's got a reasonable volume. Not on AIM, which means it's on the main market. This is a conservative search, and the price of the share is less than the value, and it's not on a sell recommendation. That means it's either on a VectorVest hold recommendation or a buy recommendation. And what I've done is that I've sorted those shares by safety of earnings. And that brings those shares to the top of the pile that have got the best safety of earnings. As I say, it's a very conservative search. Now, if I go to the start of 2019 and go to Wednesday the 2nd and run that search, you'll recognize some of the shares that are at the top. JD Sports, for example, we all know. And all I'm going to do is to do a linear test. Now, that linear test will be the first 2 months of 2019. And if I test the top 10, that's what I get, folks. That portfolio, and that's one of our most conservative portfolios. No AIM stocks, no penny stocks, where the price is less than the value, sorted by the quality of earnings. Remember, three things that are important in the stock market: earnings, earnings growth, and earnings safety. And here we're in fact sorting by earnings safety. We want those shares that have the best track record of making money and growing earnings without any blips to the top of the pile. And that portfolio is up 16%, and the London stock market is up 5.08%. So it's outperformed the London stock market by 3x, folks. And there's not a loser in sight. The worst one is Lion Trust, that's up 0.5%. So, and I assure you that all you had to do was to look at that for we could put the portfolio into a watch list with VectorVest. There's an app on your phone, and it can all be kept under control while you're having a cup of coffee in Costa. So that's an example of a very conservative portfolio. So let's move on to back into my presentation. And that was my let's do it slide. All right. So if we move to my question, how is this different from what you've been doing to date? Somebody just said a lot. Okay. So you can choose to be overwhelmed or get your answers quickly. As relatively small investors, folks, we haven't got the time, and many of us haven't got the tools to spend 60 hours a week, even if we had the time. So it's important that you get the good stuff, and as I say, the good stuff is all about earnings. It's all about trends, stock analysis, and trends. So how do we put this together in 10 minutes? How do we go from stressed out to confident, to consistent success? Well, that's Rob. You remember Rob? The poor bloke thought he was going to have to get a job again. And before getting a job, he started to, in fact, do his own research. He spent days, he says, in front of the computer, listening to reports, reading articles, and he just got so confused, he became totally and utterly beyond despair, he writes. But he put together a plan, and with VectorVest's help, he put together the following plan, which we teach to show people how to keep this under control in a few minutes a day. First of all, there's very little to do, but we put it into this little matrix of a few blocks, 9 blocks. And when to buy, what to buy, when to sell. Fairly straightforward, I think you would agree. All right. As I said earlier, we need a totally objective signal from the market when it's safe to buy stocks. You can do that with moving averages in the S&P 500. At VectorVest, we have a much faster system that will get you in closer to the bottom, get you out closer to the top. But you need, with respect, to know when it's safe to be in the market. Buy and hold works beautifully if you've got 21 years to wait. My father told me that in the 1970 market top, 69 in fact, market top, that it took the London stock market 21 years in real money to break that top. Okay, so buy and hold is great if you've got 21 years. So you need to know exactly when it's the right time to be in the market. When you buy, we would want the market to be rising that day. And we want the stock to be breaking up through a new high. And most people would do this by putting a resting buy order in the market, maybe above yesterday's high. Now, what to buy is simply, share is rising in prices, what we've just covered, rising earnings, and favor undervalued stocks. And when to get out, folks, you need to know when it's not safe to be in the market. Now, many people would just run for cover at that stage, or you would certainly not be buying any more stocks and watching the stop losses and exits on the share that you've got very carefully indeed. We'd want a stop loss, certainly for every share in the market. And a profit target. Now, Rob, in our example, always had a profit target, and however, you could decide not to have a profit target, but to manage the trade by some form of trailing stop loss, either a percentage behind the market. And VectorVest calculate a stop loss every day that you could use as a trailing stop loss. So many, many ways to do that. Many traders are happy to risk £1 to make £3. In other words, they'd buy a share at £10. Stop losses, let's say, diagrammatically at 9. And if the share got to 13, they would have made 3 times as much as they've risked. So, and by doing this, Rob has turned that portfolio around, and he writes in March 2009, using VectorVest's unique market timing together with fundamental and technical analysis and stock picking techniques, he went into the market, and by the end of the year, he'd made his money back. And now, using that little plan that I talked about with that 9-box matrix, he spends minutes a day managing his portfolio, giving him the time to do what he really wants to do. That's him and his wife and his son. So out of all of that, which area do you need to work on first? Well, I've told you my story. I needed to work on stock analysis first. Which area do you need to work on first? Getting market timing coming through. Yeah, folks, there's 70% of the exercise is knowing when it's safe to be in the market, when it's not safe to be in the market. For example, in the latter half of 2018, from October the 5th, the London stock market started to fall, and it fell until the start of January. And that was a time certainly not to be buying any more stocks and watching the stop losses on the stocks that you have exceptionally carefully. So if you're not satisfied with your results, and I can't imagine you'd be here if you were, and you're buried up to the eyeballs in data, and your returns are up and down, and the confidence has been kicked out of you, that's the most common thing I hear going around the country, and your portfolio is not where you want to be, and your dreams are not where they want to be. You can choose stocks that are falling, or you can choose to invest confidently, and you can choose consistency over inconsistency. You've got some thinking to do. You've got to say to yourself, how can I create this type of system in my own portfolio? Well, you have a choice, folks. You can do it yourself. Now, that was me 30 years ago, trying to come to terms with the annual reports, and I assure you the office wasn't nearly as orderly as that. They were everywhere, absolutely everywhere. When I went to the post box, they would be stuffed in at all angles, and I just chucked them away. Now, to break out of the box, at VectorVest we put together what we call the Successful Investing Quick Start course, which will give you this information with very little effort on your part. Its objective is to consistently outperform the market in 10 minutes a night. Now, old Einstein has been vastly overquoted here, but he said that everything should be made as simple as possible, but not simpler. So, folks, this is not a get-rich-quick scheme. This is a process for those people that want to take their wealth building seriously and are happy to roll up their sleeves to make this material their own. It won't take that long, but it's going to take a little bit of commitment. And if you haven't got that commitment, then please switch off now and go to any one of the million get-rich-quick schemes on the internet. This is not that. This is serious. The objective is money, security, and freedom. And so I'm going to map it out for you. Week number 1 is all about stock analysis. You're going to become an expert in how to actually get to the good stuff of valuation, earnings, earning safety, and earning growth, dividends in 30 seconds. How to analyze any stock in 30 seconds. You're going to be able to look at your own portfolio and see immediately which shares are good and which shares are awful. And that will allow you, folks, to weed your portfolio. It'll allow you to get rid of the bad ones and focus on the good ones. Always keep what shows you a profit and get rid of what shows you a loss. Again, a quote out of Reminiscence of a Stock Operator. You'll know and understand risk management. You'll know how to minimize losses. You'll know how to maximize gains. So, in lesson number 1 and 2, we'll show you how to work out the bad shares in your portfolio, and we'll show you how to replace those with good shares. Lesson number 3 is all about market timing, and at VectorVest we've color coded this, and that's why it's called Become a Green Light Buyer, to know when you've got a green light that it's safe to be in the market. And number 4 is cherry picking the very best stocks for your portfolio, and we'll give you 2 cherry picking techniques. That will mean that you won't be have to read the tips in the newspaper or subscribe to a tip list. You'll know exactly what to buy. And number 5 is a 10-minute management plan, which is an awful lot more detail on that 9-part matrix that I talked about a few minutes ago. That'll simplify your day. Now, in the US, they sell that for $475, but in the UK, we're new, and if you roll up your sleeves, folks, and work with me over the next 30 days, we'll turn your portfolio around, or even if you've never been near a market before, show you how to actually get started. So module number 1, stock analysis. Module number 2, getting rid of the bad ones. Module number 3, knowing when it's a really good time to be in the stock market objectively. And then module number 4, finding really good shares to replace those ones that you've kicked out. And then module number 5, the plan of how to put it all together. And in the UK, that's a total price of £5.95. And if you would like to work with me for 30 days, then vectorvest.co.uk/SIQSC. And we're going to give you 30 days access to VectorVest, both VectorVest UK and VectorVest USA, which will do all the heavy lifting for you. And that's a £49 value, which is included in that £5.95. And of course, we're going to give you, we're not going to give you a whole pile of lectures and then leave you. The weekly group coaching. And I do a weekly coaching session on a Monday afternoon. It's recorded. You can play it anytime. And my colleagues in North America do one on a Tuesday evening, which is recorded, and you can play at any time. We have user groups around the country, and you'll be welcome to those user groups if you can make them. User groups in London, Guildford, Oxford, Taunton and Somerset, Manchester, Birmingham, Edinburgh, Belfast and Dublin. And we hope to start something in Bournemouth quite soon. And if you can't get to those, then we support the product via webcast. And of course, we also give you an 0800 number that gets you through to our call center. Our call center is open 12 hours a day from 12 o'clock lunchtime to 12 o'clock at night. And we've done this for lots and lots of people around the world. And I've worked here with Tom, and he says that he's even got a plan after all these years. Can you believe it? So vectorvest.co.uk/SIQSC. It's £5.95, and literally thousands of people around the world have done this. It's new in the UK. So just think of which one of those mistakes has cost you money over the years. And certainly stock analysis was my problem. I just didn't have the skills to put it all together, didn't have the time or the inclination to put it all together. And that was yours truly with his head in the sand, because when I added that to my matrix, my hit rate went up and my risk to reward went up, and that means my profitability went up considerably. So how much is it costing you not to have this information? And that's what we're going to cover. vectorvest.co.uk SIQSC. It's £5.95. And folks, if you don't think it's the best £5.95 you've ever spent, I'll give you a full money back guarantee on that. So our 30-day, 5-part investment course, full access to VectorVest UK and VectorVest USA, weekly coaching from both myself and my colleagues in North America, an 0800 number that you can phone as often as you want. There's no limit on the number of calls you can put through. It's open 12 hours a day. And of course, if you can make it, our user groups around the country. So I'd love to work with you. And if you fill in, just go to that link and fill in your name and details, and we'll get you up and running ASAP. Thank you. Thanks very much indeed. Take care of yourselves. Bye-bye.